Alright, folks. Welcome back to another episode of Boss Economics World, where we strip back the glossy numbers and meaningless press releases to expose the real problems driving our global economy under the guise of central government mismanagement. Today's hot topic: the Federal Reserve's latest dance around interest rate cuts, an issue that's being presented as a diligent recalibration of economic policy but is, in reality, a flagrant confession of a struggling system built to wobble at the slightest pressure. Brace yourselves, because today we are diving into the economic undertones behind the words of Federal Reserve Bank of San Francisco President Mary Daly and her cohorts. We will unpack the subtext of their comments, not just from a professional financial perspective, but also for our lay audience that intuitively knows something doesn't feel quite right. So, what's at stake here? Let's break it down. The first, and perhaps most glaring, takeaway in Mary Daly's statement about the prospects for an interest rate cut is the uncertain, almost hesitant tone of the Federal. Let's be clear. When central bankers start scrambling to recalibrate policies without actually committing to decisive action, it means one thing: they don't know what's going on with the economy. Well, not exactly, they know, but it isn't encouraging. The US economy is on incredibly shaky ground, and manipulating interest rates at this juncture is like tinkering with the brakes of a speeding car while trusting it'll stop in time. Now, according to Daly, the Fed is considering a continuation of rate cuts but not necessarily committing to doing so this month. Why the indecision? Behind all this cautious rhetoric and equivocation, we're seeing lingering economic stagnation, where the short-term fix of rate cuts is being used like aspirin instead of recognizing that deeper, more inflammatory problems exist in the structure of the economy. Back in September, the Fed already lowered interest rates. And now, cutting them again. For the third time. You see, ladies and gentlemen, how deep the hole has already been dug. They tell us rates might come down further next year. But think about that. The Federal Reserve is on an endless loop of lowering rates, continually sending the message that growth is not sustainable at higher rates, that the system literally cannot withstand higher interest rates without collapsing under the weight of its own unsustainable debt. The big question they won't address up front: why does this economy keep needing life support in the form of rate cuts, fiscal injections, and artificial interventions? If you're constantly adjusting rates to stimulate the economy, how healthy do you think this patient really is? I'll tell you, it's not. As Chicago Fed President Austin Goolsbee mentioned, we can expect interest rates to come down a fair amount over the next year. This is because the structural issues driving the economy are so deep-rooted that keeping rates at a level valued by traditional means only exacerbates the fragility of the system. But the Fed, like someone tangled in the strings of their own puppet show, finds itself forced to pull those strings again and again. Another key element to this interest rate conundrum is, unsurprisingly, inflation. Policymakers like Daly and her peers have paid lip service to the idea that inflation is steadily declining, and progress is being made towards the 2% goal, which, by the way, seems like their holy grail. But let's ask the important question: are we really on a sustainable path to tame inflation? Let's scrutinize the actual numbers a bit, and this is where things get uncomfortable for policymakers. Despite some reductions, US inflation continues to hang above the Federal Reserve's ideal target of 2%, as reflected in the most recent Consumer Price Index (CPI) data. Investment banks like Goldman Sachs and JP Morgan have pointed out in their latest quarterly summaries that inflationary pressures persist in key sectors like housing and services. But why isn't inflation dropping as fast as they promised? The structural issues that the Fed won't talk about openly are driving it. Behind the curtain of these pronouncements from monetary policymakers is a tangled web of supply chain distortions, debt-fueled consumption, government spending binge, geopolitical tensions, supply chain decimation due to the Russia-Ukraine war. True, the Fed and its policymakers, such as Fed Governor Adriana Kugler, insist that inflation is on track. But when key global pressures, and local supply-demand mismatches, remain, this becomes a fragile promise. And it's exactly why they're playing this carefully modulated game of dragging their feet when it comes to further interest rate hikes or cuts. I hear you all asking, alright, you've jammed in plenty of financial jargon, but what's the bottom line for us regular people who just want to buy groceries, pay rent, and maybe save some money? Well, the truth is that the Fed's so-called recalibrating means economic uncertainty for everyone. 1. Price instability. Think about going to the store every month and noticing that goods are still fluctuating wildly in price. 2. Diminished economic confidence. If the Fed can't even make up its mind, whether they're cutting, staying put, or hiking, you can imagine the lack of predictability that spills over into businesses and family life. What would a persistent inflation hemorrhage mean for the broader US economy? Global confidence in US markets and the dollar could continue to waver, especially with external crises, think decoupling from Chinese supply chains, or economic pressures in Europe, hovering in the background. If you thought that America's monetary policy stays neatly within its own borders, think again. The latest whispers from Fed governors like Christopher Waller have indicated a looming rate cut, but whether this happens in December or beyond, the decisions being made here in the US are already causing shockwaves across global economies. And this only adds to the volatility driving financial markets around the world. But let's throw in some solid recent data to explain where the rubber meets the road internationally. 1. China's financial instability, Beijing's clampdown on its private sector, coupled with massive local government debts, risks downward pressure on the yuan and capital flight. If US rates keep falling, we're pulling the rug out from under the already spiraling Chinese economy. 2. European Central Bank, ECB over there in Europe, Christine Lagarde is balancing a tightrope act as well. The EU is staring at stagnating economic growth rates, with inflation still a persistent headache across many member states. With significantly reduced fiscal flexibility after the recent debt blowouts, remember Germany's stimulus packages, Europe remains overleveraged, and the ramifications of US policy shifts could deliver a significant blow to the Eurozone's fragile recovery. 3. Emerging markets vulnerability, Argentina, Turkey, and South Africa are already deep in fiscal messes of their own. Rate adjustments from the Federal Reserve will either strengthen or weaken the US dollar, hence it directly impacts these emerging markets' ability to service their external debts. Dollar-denominated debt becomes either more expensive or slightly less so, depending on whether interest rates fall or rise. It's the proverbial sword of Damocles. Let's not forget the ever-shifting flows of global capital. U.S. debt remains impossibly massive, standing at over $33.6 trillion in 2024, and interest payments on the national debt alone are devouring a growing share of taxpayers' money. In the Fed's indecision lies the ever-rising risk that America could become a less attractive borrower in the global market. International investors are watching carefully, and if the Fed fails to handle its policy-making confidently and swiftly, putting off stronger than needed action for incremental rate cuts just to stall until the general election, the risk is volatility and dollar depreciation. We could see the US dollar's position as the world's reserve currency lose more ground. So, what do the hesitant and sometimes contradictory statements from Mary Daly and her colleagues really imply? To say the least, we are nowhere near the economic recovery or stability that these policymakers would like you to believe. Their press conferences might as well be creative writing classes at this point, deliberately vague so as to project calm, but the realities of an unwieldy debt load, unpredictable inflation, and global volatility swirl just beneath the surface. We aren't advocating for panic here on Boss Economics World. But we do need to be aware of the real consequences of these decisions because the illusion of control is the biggest danger right now. The Federal Reserve wants us all to believe that cutting rates eventually will throw the economy onto the right track. Don't fall for it. Staving off crisis with short-term fiscal tinkering doesn't resolve the larger issues at play. As we look ahead to 2024, the risks for everyday Americans are stark: wage suppression, continuing inflationary pressure, geopolitical supply chain disaster zones, and rotten global economic resilience. But hey, what do we know? We're only the ones living through it. Thanks for tuning in again to Boss Economics World.